Hi everyone, I'm Hamish Maxwell, Director with Baillie Gifford and an investment specialist with Scottish Mortgage, which is one of the UK's largest investment trusts and Baillie Gifford's longest standing client. Scottish Mortgage is a very well-known UK investment, but some of you might be less familiar. I sometimes think it's good to begin by dispelling a red herring in our name, in much the same way that consumer electronics company Apple has nothing to do with selling fruit and veg, and the French luxury goods company Hermès is not literally the Greek god of wealth and fertility of the same name. So too, the company Scottish Mortgage has little to do with Scotland and even less to do with mortgages. It's a legacy name from over 100 years ago when Baillie Gifford and Scottish Mortgage were both founded to work together, looking for the best growth investments. We're rather fond of the name and we've kept it. Scottish Mortgage is not about Scottish real estate. Rather, it is about the pursuit of extreme returns. We want to own the very best growth companies from around the world and offer those returns to our investors. My presentation is about what makes Scottish Mortgage a distinctive opportunity. If we move to the next slide, please. Our purpose is simple. That's to maximize total returns over the long term, and we seek to offer a liquid and low-cost portfolio of exceptional public and private growth companies, and this is a rare combination. The businesses we want to own are addressing large and growing opportunities. They have strong competitive advantages. They are disrupting the industries or even creating new ones, and many are founder-led with cultural advantages too. However, exceptional companies don't change or create new industries overnight. It takes 5 to 10 years or more, and there will be mistakes along the way. And that's why our end of the bargain, when we find the best growth companies, is to be patient and supportive shareholders. But that's not always easy. Humans are not naturally very patient. We often prefer immediate gratification. After all, through most of our long history, that's what mattered. The timeframes our ancestors had to think about in terms of hunting and agriculture were the 4 seasons of the year, and so it's perhaps no surprise that the market is so obsessed with short cycles built around the 4 quarters of the year. But this innate short-termism jars with the requirements of the modern economy. In this age of capitalism and industry and longer life expectancy, investments must be made over multi-year, even multi-decade horizons. Converting new ideas and new technology into growing businesses takes time, but if successful, the rewards can be profound. On the next slide, we can see our long-term share price going back over a century. The relationship between Scottish Mortgage and Baillie Gifford goes back over this 116 years, and it has created excellent long-term returns. Over that century, apart from inevitable moments of adverse sentiment and volatility, like the 1970s oil crisis, dot-com bubble, the global financial crisis, and post-COVID, Scottish Mortgage has been a very successful investment. It's pleasing for us to have delivered these good long-term returns, and looking forward, as I'll explain, we believe there's lots more to be excited about for the patient investor. On the next slide, we're showing certain characteristics which we think are important for good growth investing, and we also think are quite hard to find in the investment industry. I make the case that Scottish Mortgage embodies these characteristics, which make it a distinctive opportunity. I'll cover these in turn, a few minutes on each. We are not interested in the status quo. We are interested in the future, in new ways of doing things, and in growth. Next slide, please. The first characteristic, seeking outliers. And please don't feel the need to read the dense footnote just now. I'll talk us through the big picture. The asymmetry of stock market returns is very clear, and it should inform decisions about equity investing. The stock market globally is made of thousands of companies, but returns are not evenly distributed across every company. Rather, the biggest returns are driven by just a few businesses. The extent of this skew often surprises people. A study by Professor Hendrik Bessenbinder from Arizona State University, shown here, revealed that of the 61,000 listed companies globally since 1990, 61% of them underperform T-bills, which are US government short-term bonds, so basically the risk-free rate. 38% of all listed companies merely offset that value destruction. So only 1.3% of listed companies created all of the wealth above T-bills, around $44 trillion. In other words, when you're seeking good returns, only a few companies actually matter. To own the big winners, you can invest either passively, in which case you're guaranteed to own them because you own the whole market, but you will dilute your returns with the 98% of the market that in aggregate equates to T-bills. Or you can back a stock picking process that aims to invest in just the biggest winners, in which case your returns might be exceptional. On the next slide, we see that asymmetry has been at work in the Scottish mortgage portfolio. Our good long-term returns have been driven by a few big winners. Now, inevitably, we experience losses in some of our holdings. For instance, Northvolt, one of our private companies in the battery industry, recently struggled through lower than expected demand and problems ramping up. And that shows on the bottom of the page here among our biggest losses. However, the most you can lose in one company is the original investment, 1x or 1 times. But the returns from the biggest winners can be unlimited. Our gains from SpaceX last year alone were much greater than our losses in Northvolt. Longer term, NVIDIA, the AI chip company, which we bought in 2016, has grown 80 times in a decade. Tesla, which we bought in 2013, grew 25 times in size before we started selling it down last year. And Ferrari and semiconductor company ASML have each grown around 10 times. Our biggest winners have substantially outsized our biggest losses. On the next slide, we're showing that the best performing long-term growth companies are also often the most volatile in the short term. For example, see the growth of NVIDIA on the left and Spotify on the right over the periods we've owned them. Good long-term growth comes with short-term volatility, shown by the orange bubbles. This is because different variables play out over different horizons. Long-term returns follow profits, as investors wish to own the biggest cash flows. That's intuitive. So companies that grow their profits 5 or 10 times in a decade will be worth more as a result. Whereas over the short term, share prices are unpredictable because, stating the obvious, future profit growth hasn't happened yet. It must be forecast. And the market's ability, indeed its willingness to forecast profits, is determined by emotions and sentiment of news, by trading volumes, and by lots of unpredictable politics and economics. To seek the best rewards, we must be patient, even during inevitable periods of adverse sentiment. On the next slide, this brings us to our next characteristic, the belief that change drives growth. If you want to invest in the biggest winners, one approach is to look for the few companies harnessing valuable change, such as new science, new technology, new business models, and new demand. The link between change and returns is the intuitive combination of 2 facts. 1, profits drive share price over the long term. 2, consumers prefer to spend their money on new and improved products and services, which some companies go about providing. You think of all the valuable industrial revolutions that came before us: steam, electricity, flight, computers. Now think of that process of industrial revolution as ongoing: artificial intelligence, genetics, robotics, connectivity. Today, the global stock market is worth a staggering $77 trillion. But most of its thousands of companies are being disrupted by a few innovators. And here is a big opportunity for investors. On screen are examples of growth trends in the Scottish mortgage portfolio. For example, the evolution in transport with electric vehicles BYD from China, drone delivery company Zipline, and air taxi company Joby. The digitalization of finance with investments in Stripe and Wise, and transformation in healthcare with Tempus and Recursion applying technology to improve life expectancy, to name just a few. These companies are driving change and taking market share. With the next slide, let's look deeper into one example: artificial intelligence, or AI. After decades of science fiction and years of investment, AI is finally here, and it is changing the world. The rise of AI has been a recent contributor to market performance. Phase one is the hardware that makes AI possible, which is the microchips or the semiconductors. At the heart of this supply chain, you find our holdings NVIDIA, TSMC, and ASML. As a trio, they each do something unique and vital. NVIDIA designs the best chips for AI, TSMC makes the chips for companies like NVIDIA, and it does so using ASML's machinery. Next in the AI supply chain is infrastructure. Companies using chips to create huge AI models. These include cloud providers, network infrastructure, data analytics, and security software. Scottish Mortgage investments in this phase include Amazon, Meta, Snowflake, and Databricks. Then we have the companies applying AI to their business models to grow revenue and improve productivity. In our portfolio, examples include BYD, using AI for autonomous driving, and Tempus, using AI for healthcare diagnostics. Lots of exciting examples of AI driving change and therefore driving growth. Some of the things these companies have in common are the benefits of being led by technical founders, of scale, and of deep pockets for investment. On the next slide, we're sharing the third characteristic that gives us an edge, our structure as an investment trust, which we've had for over a century. As Dan helpfully put it, as a closed-end fund, basically it means we sell a certain number of shares for a certain amount of capital. So those shares that are traded, that capital we invest. Because of this structure, we can invest, we can focus on long-term investments without the need to liquidate assets prematurely. You can see you searching for the slide there. It's just that blue circle and orange circle. Thank you very much. We aim to actively manage our share price around net asset value through issuing or buying back shares. We recently went through a period of greater than usual discount, and the board has therefore been actively buying back shares. We do employ some modest gearing to enhance long-term returns. Returns must exceed the cost of borrowing to help, not hinder, but our careful management of gearing has historically contributed to returns. As one of the UK's largest investment trusts and a member of the FTSE 100, liquidity is there when you need it. We keep our fees low at 0.35%, well below the industry average, so our investors keep more of any returns. Our structure also allows us to have up to 30% of our portfolio in private companies, which are illiquid, but our trust structure allows us to offer them in a liquid form. The next slide, private companies. This is our fourth characteristic that gives us an edge, because many companies are now staying private for longer, so the relevance is increasing. The average age at listing has gone up 8 years to 12 years, and the amount of value in late-stage capital markets has gone from $10 billion to $2 trillion. And for us, the distinction of IPO is arbitrary. On the next slide, we can see a bit of our private company exposure. About 28% of our portfolio is in private companies, including 6 of the world's top 10 most valuable private businesses. For example, our largest private position is SpaceX at 7% of the portfolio. SpaceX is leading in low-cost space logistics and satellite internet connectivity. We invested when it was worth $30 billion, now it's worth $350 billion. We also have ByteDance, another of the world's largest private companies and owner of TikTok. ByteDance is changing how digital content is produced and consumed. We invested when it was worth $75 billion, now it's worth $300 billion. Our private portfolio has strong fundamentals. Half are cash generative, others have healthy cash balances and are on paths to profitability, and they're mid to large cap, worth $10 billion or more. On the next slide, we can introduce the idea that even if an equity portfolio wishes to own private companies, it doesn't necessarily mean it can. Private companies get to choose their investors. That's a key difference with public markets. Our reputation as long-term supportive shareholders often makes us preferred investors. Many company founders approach us directly or through introductions, which gives us access to high quality deals and long relationships with visionary founders. We have a well-resourced private companies team at Baillie Gifford and a rigorous valuation process our investors can trust. This means a broader opportunity for growth. On the next slide is the fifth and final characteristic that I think makes Scottish Mortgage a distinctive investment, which is our mindset. And we aspire to be curious, patient, and brave. Next slide, please. Curiosity matters because to beat the market, you need different views to the market. We don't focus on the short-termism and consensus of the finance industry. Our information sources are open-minded, such as academics, research groups, expert networks, and private companies. We view growth trends like healthcare and renewables as real issues requiring practical solutions, not as abstract financial concepts. On the next slide, patience matters because you don't drive valuable change overnight. It takes 5 to 10 years or more. The evidence shows that the market is focused on the short term, whereas our average holding period is nearer 10 years. Patience allows the capture of compound growth and avoids costly decisions during market fluctuations. Next slide, please. And bravery matters because reward comes from taking risk. Here we're showing how differing concentrations compared with the market. We must stand apart from the crowd and embrace the unconventional. We need the courage to invest in transformational growth, even when it's out of favor. This allows the pursuit of growth that others might shy away from. And on the next slide, we can see the output, a portfolio that has delivered strong sales growth and earnings growth 2 to 3 times greater than the benchmark. This matters because we know that regardless of short-term sentiment, sales and earnings drive share price over the long term. On the next and final slide, in summary, our purpose at Scottish Mortgage is simple: maximize total returns over the long term. We aim to do so by offering investors a unique opportunity, a liquid and low-cost portfolio of exceptional public and private growth companies. Notwithstanding inevitable periods of volatility and adverse sentiment, our approach has been extremely valuable over the long term. Perhaps most importantly, we are really excited about the potential for upside from here. Thank you.